If you want to make consistent profits in crypto without holding positions overnight, scalping might be the strategy for you. Scalping is all about capturing small price movements multiple times per day. Instead of waiting for massive breakouts, you focus on quick entries, controlled exits, and strict discipline. But here's the truth. Scalping only works when you follow a structured system. In this video, I am going to walk you through a complete, beginner-friendly crypto scalping strategy, including the exact indicators, timeframe setup, entry rules, and risk management principles you need to survive and grow. When you're scalping, liquidity is everything. You want tight spreads and deep order books so you can enter and exit quickly without slippage eating your profits. That's why beginners should stick to high-volume coins like Bitcoin, Ethereum, and Solana. These coins move consistently and have enough trading activity to support fast execution. Avoid low-cap or hype-driven meme coins when you're starting. They may look attractive, but unpredictable volatility and thin liquidity can destroy a small account very quickly. Now, let's discuss timeframe structure. This strategy uses multi-timeframe alignment. You will use the 15-minute chart to determine the overall trend direction, and the 1-minute chart for precise entries. The biggest mistake beginners make is trading only on the 1-minute chart without understanding the larger context. The 15-minute timeframe acts as your filter. If the 20 EMA is above the 50 EMA on the 15-minute chart, you only look for long setups. If the 20 EMA is below the 50 EMA, you only look for short setups. This alignment significantly increases your probability. We keep the indicators simple. Just 3 tools. First, the 20 and 50 exponential moving averages. These help you identify short-term momentum and trend direction. When the 20 IMA is above the 50 IMA, the market has bullish momentum. When it's below, bearish pressure dominates. Second, we use VWAP, the volume-weighted average price. VWAP shows the average price institutions are trading at during the day. If price is above VWAP, buyers are in control. If price is below VWAP, sellers are in control. Third, we use RSI set to period 14. In an up, we look for RSI to pull back into the 4250 zone before buying. In a downtrend, we wait for RSI to bounce into the 50 to 60 zone before selling. We are not chasing extreme overbought or oversold conditions. We are trading pullbacks within a trend. Let's break down the long setup, step by step. First, confirm that on the 15-minute chart, the 20 EMA is above the 50 EMA. Second, price must be trading above VWAP. Third, switch to the 1-minute chart and wait patiently for price to pull back toward the 20 EMA. At the same time, RSI should cool off into the 40 to 50 range. Then wait for a bullish confirmation candle, a strong green candle closing above the pullback structure. Only then do you enter. No guessing, no anticipating. You wait for confirmation and then execute. For the short setup, everything is reversed. On the 15-minute chart, the 20 EMA must be below the 50 EMA. Price should be below V. On the 1-minute chart, wait for a pullback toward the 20 EMA, while RSI rises into the 50-60 zone. When a bearish confirmation candle forms, you enter at the close. This mechanical approach removes emotion from your trading decisions. Now we come to the most important part: risk management. Scalping produces small profits per trade, so protecting capital is critical. You should risk only 0.5% to 1% of your account per trade. If you have a $1,000 account, you should only risk $5 to $10 on any single trade. Your stop loss should go below the recent swing low for longs or above the recent swing high for shorts. Alternatively, you can use a fixed stop between 0.2 to 0.4%, depending on volatility. Your take profit should aim for at least a 1 to 1.5 or 1 to 2 risk to reward ratio. If you risk $10, you target $15 to $20. Scalping is about statistical consistency, not hitting jackpots. You also need daily protection rules. Stop trading after 3 consecutive losses. Set a maximum daily drawdown of 3% of your account. If you hit that limit, you stop for the day. No revenge trading. No doubling down to recover losses. Discipline is what separates profitable traders from emotional gamblers. If you maintain a win rate between 55 and 65% and consistently apply a minimum 1 to 1.5 risk-reward ratio, you create a mathematical edge. Over time, that edge compounds. Most beginners fail not because their strategy is bad, but because they break their own rules. They overtrade. They increase position size after a loss. They ignore fees. Or they trade random coins without liquidity. This strategy is simple, structured, and repeatable. Start by paper, trading it for 2 weeks. Track every entry, exit, and mistake. Focus on execution quality, not profits. When you can follow the rules consistently without emotion, only then move to real capital. Scalping is not about speed. It's about precision and discipline. Trade with a plan, manage risk like a professional, and let consistency build your results over time. If you want, I can now create a more dynamic version with emotional pacing cues for AI narration, or a high-energy version optimized for retention and engagement.